If you had $100 million and you wanted 5% Bitcoin, you could buy $5 million of IBIT, or you could buy less. You could buy $2 or $3 million of MicroStrategy because we're like 2x Bitcoin.
Silver demand skyrocketing by 800%, and gold and silver on the brink of becoming priceless? The truth behind this shocking surge is even more chilling than you think. Banks are scrambling for cash, and the entire market stability is hanging by a thread. From stocks to bonds and crypto, everything is caught in this tangled mess. Meanwhile, the deep state is playing their cards, and their target, your financial freedom. Tune in as we expose how Bitcoin is being used to push inflation onto unsuspecting nations. Gold's hidden power. Take a closer look at the stock market. It's reaching new heights with the S&P at all-time records. But beneath that shiny surface, there's an unsettling truth lurking, a tangled knot tied with the repo market, ready to unravel. Banks are scrambling for collateral, and cash, becoming a rare treasure. Every market, stocks, bonds, even crypto, is wrapped up in this convoluted mess. Think gold and silver can just waltz out of this? Think again. Even these so-called safe havens are getting dragged into the madness. There's a twist coming that could send shockwaves across every financial sector. A twist so big it's something most experts aren't even talking about yet. Who's saying all this, you ask? It's not just me. The deep state and big banks are practically shouting it, but not without avail. They want you to believe Bitcoin is the real savior here. But the question remains, whose interest does it actually serve? When you dig a little deeper, it all becomes pretty obvious. Bitcoin is just another tool used to finance government debt, to push US inflation onto unsuspecting nations. Nothing's changed since 1971. It's the same game, just under a new disguise. Could Bitcoin be just another instrument to push US inflation into struggling economies? Spoiler alert, very likely. The repo market is welded to the equity market now, and it's not just Bitcoin that's in trouble, it's everything. We're talking about a total collapse, a house of cards ready to fall. Bitcoin, gold, silver, it's all going down. The question is, will anyone be safe? Everyone loves the idea of financial liberty, that sweet, warm feeling of freedom. But guess what? The deep state loves taking that feeling, throwing it in the trash and lighting it on fire. They're making it clear. Bitcoin is being used to finance government spending and spread US inflation far and wide. And who's profiting? They are. While the rest of us are left in the same tired cycle, they're laughing their way to the bank. Remember Howard Lutnick, the boss at Cantor Fitzgerald? He laid it out in plain sight at a Bitcoin conference. The distribution of USD Tether across emerging markets is propping up US debt. Each time someone buys Tether, they're effectively buying US treasuries. For all those folks in emerging markets who think they're breaking free from the system, sorry to break it to you, but you're just funding the next American spending spree. It's one big loop, a Mobius strip from financial hell. Tether is backed by US treasuries, which prop up the US dollar, which you then use to buy Bitcoin, which is backed by Tether. Round and round it goes, a never-ending spiral of nothingness. When you buy Bitcoin, you're just adding fuel to the fire. But when you buy gold or silver, you're stepping off the merry-go-round. You're getting out of that twisted loop. And that's why they couldn't care less how high Bitcoin goes. But gold and silver? Those scare them. Bitcoin could reach the moon for all they care because it locks more dollars into a cycle they control. But gold and silver? They're different. They're real threats to power, the antidote to inflation. That's why they suppress their value. Why they do whatever it takes to keep those metals down. People keep asking, when will you admit you're wrong about Bitcoin? When will you say it's real money? Here's my answer. If during the next financial crisis, which by the way is coming soon, Bitcoin can keep its value stable against gold ounces, not dollars because dollars mean nothing, then I'll admit I was wrong. But I don't think that's going to happen. We'll see, but I bet Bitcoin will fall harder than before. Gold survives. Bitcoin faces collapse. Last time, Bitcoin dropped from 37.5 ounces of gold to about 10 in a crunch. This next crisis? I think it'll be even uglier. Bank reserves are plummeting, and when they dip below $3 trillion in the next few weeks, we're in for one wild ride. Gold's price? It's been taking a hit lately, dropping from about $2,800 to around $2,570. But here's the kicker. Open interest hasn't dropped. Banks are stuck in their short positions and can't cover them. They're trapped, and that's a big problem. They're digging in deeper, unable to unwind their bets. The tension is building, and we all know what happens when that tension finally snaps. And let's not forget about the yield curve. The 10-year minus 3-month yield spread is almost back to normal. History tells us that when these curves normalize, recessions follow. Remember 1991, 2001, 2008, and 2020. It's all about to repeat itself. The next financial crisis is right around the corner, and it's set to be the worst yet. Why? Because the credit bubble today is bigger than ever. The higher the inflation, the worse the crash that follows. JP Morgan is already seeing a surge in demand for equity-backed repos. What's that, you ask? It's when a bank hands over a bunch of stocks to get cash. Why now? Because the stock market's at an all-time high, and those equities are worth more as collateral. The repo market, the equity market, they're all tied together. And when one of them falls, they all come crashing down. So where does that leave us? Bitcoin, gold, silver, all are going to take a hit when the liquidity crunch arrives. Sure, gold and silver might fall less, but they'll still drop. The difference is when the dust settles, gold and silver will still be there, while everything else, stocks, crypto, all of it, could be in ruins. Every financial crisis in history has led to a surge in the purchasing power of gold and silver, and this time will be no different. Consider the 2008 financial meltdown. In that crisis, gold saw a spike in demand as people sought a safe haven, and its value soared. The same thing happened in 2020, when the pandemic sent shockwaves through global markets. Investors fled to tangible assets like gold and silver, pushing their prices up. Even when the crisis seemed to stabilize, the desire for something with real value never waned. Today, we're staring down a similar situation, but this time it's even more complex. The interplay between crypto markets, fiat currencies, and commodities has created a fragile system where every move has a consequence. Bitcoin has been heralded as digital gold, but will it truly hold up in the face of a crisis? The jury's still out, but the signs aren't promising. The repo market, that ticking time bomb, is at the heart of the coming liquidity crisis. Repos, short-term loans secured by collateral, keep the financial system running smoothly. But what happens when that collateral, increasingly equities, not treasuries, starts to crumble? The answer is simple. The entire system seizes up. Equity-backed repos might seem harmless while stock values soar, but they're a disaster waiting to happen when those stocks start to slide. The repo market has been swelling with these transactions because of the inflated stock market. Everyone's riding high, but gravity is always waiting. And when those equities fall, liquidity vanishes overnight. Bitcoin, the supposed future of finance, is tied into the very same fate. Tether, a crucial Bitcoin trading pair, is backed by US treasuries, which are directly linked to the stability of the repo market. Bitcoin isn't some independent beacon of hope, it's just another piece of this vast financial puzzle. When one piece fails, the entire puzzle starts to fall apart. Gold and silver, meanwhile, exist outside this machine. That's why they're such a threat to the status quo. Gold and silver represent value that can't be manipulated at will by central banks or institutions. You can't print gold, you can't conjure silver from thin air. And that's why the powerful despise them. They can't control these metals the way they do with fiat currency or even crypto. The broader socio-political environment is another critical factor to consider. The moves made by central banks have international consequences, often hitting emerging markets the hardest. The use of USD Tether to indirectly finance US debt is a clear example of this imbalance. Those in emerging markets are being led to believe they're escaping the clutches of traditional finance, but in reality, they're tightening the chains. And let's not forget, bank reserves are dipping below $3 trillion. Once that line is crossed, panic is inevitable. The domino effect will hit every asset, stocks, crypto, commodities. And when the chaos ensues, those with real, tangible assets, like gold and silver, will be the ones left standing. Throughout history, gold has proven to be a reliable store of value. Empires have risen and fallen, but gold has remained. Silver, too, has been both a currency and an industrial metal, adding to its resilience. In every crisis, from the fall of the Roman Empire to today, gold and silver have stood the test of time. The recent drop in gold prices from $2,800 to $2,570 seems troubling, but it's part of a bigger story. Banks can't unwind their short positions. They're stuck, and when they can't suppress the price any longer, expect a surge like no other. The silver boom is more than just hype, and now there's silver. The demand for silver is reportedly up by 800%. Why? Silver is a dual-purpose metal. It's crucial for technology and renewable energy, while also serving as a store of value. Eric Sprott, a renowned hedge fund manager, has been vocal about silver being undervalued. He believes that silver's time has come, and the market will soon correct itself. But is this really a silver renaissance? Or is it another sign of people grasping at straws as the world goes economically berserk? Only time will tell. Bitcoin, meanwhile, continues its climb. Michael Saylor of MicroStrategy is doubling down, acquiring more Bitcoin. He believes in Bitcoin's potential as a store of value, a belief shared by many big players who are now dipping their toes into the crypto waters through ETFs, like BlackRock's iShares Bitcoin Trust. But with more institutional interest comes more questions. Is Bitcoin still decentralized if big institutions are controlling vast amounts of it? Many argue that Bitcoin is being used to perpetuate the same old financial games, spreading U.S. inflation globally. He sees Bitcoin's deepening ties with traditional finance as its Achilles heel. Can a decentralized system really thrive when it's backed by entities with centralized control? The answer could make or break the future of crypto. Where does this leave the traditional safe havens? Gold and silver might be down, but they are far from out. High open interest means the big players haven't abandoned these assets. They're just lying in wait, accumulating while prices are low. When the next crisis hits and other assets crumble, gold and silver will prove their worth yet again. We're standing at a crossroads. The world of finance is shifting, and the choices made now will echo for decades. Will Bitcoin truly be the future, or just another instrument of the powers that be? Will silver finally get its due, or fade away once again? One thing's for sure, uncertainty is the only constant. As we navigate these turbulent waters, gold and silver may just be the compass that leads us to safe harbor. The complexity of the current financial landscape demands a deeper understanding of both the historical significance of precious metals and the new age allure of digital assets. Silver in particular has historically been an underdog, often overshadowed by gold. But its industrial importance adds a new layer to its potential. The surge in demand is not just a random spike, it points to a realization of its value, both as a critical component in technologies like solar panels and as a store of wealth when fiat currencies seem increasingly unreliable. Gold, on the other hand, continues to be a symbol of enduring value. In a world where currencies are printed at the push of a button, gold represents something finite, something inherently valuable that isn't dependent on government policies or the whims of a central bank. It's a hedge against uncertainty, and its role has never been more important than in today's volatile economic environment. The repo market swelling with equity-backed transactions might seem like a smart move when times are good, but it's akin to balancing on a tightrope without a safety net. Equities are soaring now, which makes them attractive collateral. But what happens when the value of those equities drops? The same institutions that are currently enjoying this system will be the ones scrambling when the market takes a downturn. It's not a matter of if, but when. Bitcoin, too, finds itself at a crossroads. It's often compared to gold, but its relatively short history makes it an uncertain hedge. It's easy to get swept up in the excitement, especially when institutional investors are diving in. However, one must consider the implications of Bitcoin's ties to traditional finance. If Bitcoin's value is being propped up by the same system it's supposed to disrupt, how reliable is it as a hedge against that very system's collapse? The idea of decentralization is at the core of Bitcoin's appeal, but as entities like BlackRock start to accumulate Bitcoin through their ETFs, one has to wonder, is Bitcoin still a tool for financial freedom? Or has it become just another asset controlled by the very institutions it sought to bypass? This centralization could ultimately undermine the fundamental purpose of Bitcoin, making it less of a revolutionary force and more of a cog in the existing financial machine. Gold and silver, by contrast, aren't tied to the success or failure of any institution. They're not reliant on technological infrastructure or vulnerable to hacking. They don't require the backing of a financial product like an ETF to hold value. These metals have survived wars, economic collapses, and the rise and fall of empires. When people are unsure of the future, they look to what has always been reliable. And that's why, despite the current dip in prices, gold and silver are likely to come out on top once again. Silver's dual role as both an industrial metal and a store of value adds an interesting dynamic. The push towards green technologies, especially solar energy, has created a growing demand for silver that doesn't exist for gold. This industrial demand acts as a buffer. While investors might be selling off in times of panic, the need for silver in technology and renewable energy keeps a floor under its price. The narrative around silver is evolving, and as more people recognize its critical role in both technology and as a hedge, its value could see significant appreciation. Another critical aspect is the geopolitical ramifications of the current financial turmoil. The actions of central banks, particularly in the United States, have far-reaching consequences that extend well beyond their borders. The use of USD Tether to effectively offload inflation onto emerging markets is a modern-day version of colonial economics, extracting value from those with less power to sustain the hegemony of the powerful. It's a zero-sum game where the winners are those who control the issuance of currency, and the losers are those who are forced to accept it. This imbalance is why emerging markets, despite adopting Bitcoin and other cryptocurrencies, are finding themselves still at the mercy of US monetary policy. They believe they were opting out of a broken system, but the reality is that they are still participants in it, just through a different mechanism. The global financial network is interconnected, and no asset operates in a vacuum, not even Bitcoin. The next few months will be telling. As bank reserves drop and the inevitable liquidity crunch arrives, every market will feel the impact. Stocks will fall, crypto will likely see a significant correction, and even gold and silver might face short-term downward pressure. However, history has shown time and again that in the aftermath of financial crises, tangible assets like gold and silver are the ones that hold their value and even gain purchasing power. Investors need to think beyond the immediate hype and focus on the bigger picture. Bitcoin might be an exciting opportunity, and silver's recent surge could be the beginning of a significant revaluation. But as always, caution is key. Diversification, a fundamental principle of investing, remains as important as ever. Gold, silver, Bitcoin, they each have their role, but none should be seen as a guaranteed safe haven. We find ourselves in a period of immense financial uncertainty. The stock market is booming, but beneath it lies a shaky foundation built on repos and overvalued equities. Bitcoin, despite its promise, is still deeply enmeshed in traditional financial systems, raising questions about its reliability as a hedge. And yet, amid all this chaos, gold and silver stand firm, their value not dictated by any one institution or government. The choices made by investors today will shape the future of finance. Will they opt for the digital allure of Bitcoin, the industrial promise of silver, or the timeless security of gold? Perhaps the best answer lies in a combination of all three, balancing the old with the new, the tangible with the digital. As we move forward, one thing is certain. Those who prepare for the worst while hoping for the best will be the ones who navigate these turbulent times most successfully. Is this the beginning of the end for our financial system as we know it? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more.